Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think this is a pretty important data set, but it's kind of painting a similar picture to what we've seen in the last few months, where we know that demand for labor is definitely coming down. You see that very obviously in the overall job openings number declining, but also in a very low hiring rate. That's a really important detail of this JOLTS data.
Looking at the inflation data, year-over-year core is still 2.8. Now, we can round all we want, but it's hard to get to 2% when year-over-year core is 2.8%. So I think they're going to hold off. I still think we're going to see, call it mild strength in the jobs data. So consequently, I believe the Fed is on hold until at least September.
Given the shift in landscape, of course, the company needs to be focused on cutting additional costs out of that system so that it can help offset the revenue pressures. But the real question here is the future of streaming and what they decide to do with Paramount Plus.
We've got 1 hour to go until the market close, so let's take a look at the major averages here, and we have a little bit of a rally, but a mini rally, let's call it. Right now, the Dow Jones Industrial Average is up 0.4%. That's about 124 points. We've got the S&P 500, very little change to the upside, as is the Nasdaq. Unclear if we're going to hold on to these gains before day's end. But here is the sort of push-pull that's going on today. We did have that JOLTS report this morning showing the lowest number of job openings in 3 years' time. That goes back to the April numbers that we got today. And so this is raising the debate once again about whether the Fed is going to be able to cut rates or not before the end of the year. Are we in a good news is bad news or bad news is good news kind of market? Sort of today. We do see another drop in bond yields, 4.34% here. So we continue to see those yields come down. Normally, that would be better news for stocks, but it's not today. And there are a couple reasons why. One of those reasons is oil, because if indeed we are seeing slowing growth here, that also means that we are going to see lower demand for oil potentially. So we've got oil futures that are lower, and that then is translating into lower energy stocks as well. So that's one of the big drags that we're seeing today. Indeed, commodities overall, you got here the XLB, that is the materials index, down about 1.2%. So between those two, that's really the big drag. You do have real estate, consumer discretionary, and healthcare stocks that are on the rise today. So that's sort of the balancing act that we are seeing in today's session, Josh.
Julie, oil prices, they are falling again today and on track for the sixth straight day of losses here. This is coming after news from the weekend that OPEC Plus is easing oil production cuts for 8 members. And joining us now is Rebecca Babin, senior energy trader at CIBC Private Wealth US. Rebecca, always good to have you on the show. So, oil has been in this downward trend. Rebecca, help us make sense of that move, what explains it, and where do you see the price headed from here?
So I equate to what happened over the weekend as being invited to a party and the host says, don't bring a gift. So you write this nice card telling the host how much you like them, your strong relationship in the future, and you show up at the party, you hand the card to the host and they look at it. You can tell by the look in their eyes that they wanted a gift. And essentially, the market wanted a gift from OPEC over the weekend. They wanted those cuts extended into the end of 2024, and we didn't get the gift, and the market's disappointed. So that was the first kind of reaction lower that we saw on Sunday night into Monday. Then on Monday, we had a weaker PMI reading out of the United States, which, as Julie just talked about, kind of dovetails and amplifies this view that economic growth is actually starting to soften. It's not in a decline, it's not panic mode, but we're not seeing further acceleration. So we saw crude kind of really get kind of spooked by the fact that, hey, barrels are actually going to be coming back. The economic picture is looking a little bit touch and go. And the last thing, and this is probably the most critical, the trend following systematic funds that trade crude oil flipped from being long to going short at the end of last week. And when we saw this negative confirmation over the weekend, they've been really aggressively pressing those shorts. So that leaves us in a place now where the marginal buyer, you ask yourself, who's going to step in and buy this dip, right? Someone's got to be there or else there's just no floor. And you say, okay, fundamental guys, where are they going to be? They're not going to buy this dip until we see inventory draws. Haven't been producing as of late, those inventory draws. That'll change this week, hopefully, and further into the summer. Not here yet, though. Macro players, they're looking at copper. It's a cleaner way to play the AI boom, inflation. That's the shiny new toy. They're not looking at crude. So it's tough to find a base here. So I think for now, we're looking for that floor. I think whenever we get overly negative and we talk about how bad things are, you got to start saying, okay, how can we surprise to the upside? And I think we're getting close to those levels where we could get that type of bounce.
Well, meantime, Rebecca, as we're looking for a floor, at the same time, have we also reset the ceiling? In other words, there was an intriguing column from Bloomberg's Javier Blas where he said OPEC Plus has now given up on $100 barrel oil. Do you agree? And if that's the case, where's the new ceiling?
That's a really great point. And I do agree. And I've always agreed with that, even when I was on Yahoo Finance last time and there was a ton of political risk. Everyone was talking about $100 crude and the spare capacity just really prevents that from happening. And I do think their strategy now has made it even more difficult to get there. I would say they have given up on $100 crude. What they want is somewhere between $80 and $90 crude, where they're able to slowly bring back production. They don't get into any political kind of tit for tat conversation with the US around prices being too high, and they have stability in the market. So I think they've given up the ghost on $100 crude, and what they want now is just to find this $90 sweet spot.
Rebecca, I'm also just curious, what are you seeing in terms of demand out of China, and how is that playing into your forecast?
It's a great question. So demand out of China over the past 2 months has been a little bit weak. And we're talking below estimates by maybe 200,000 to 300,000 barrels a day. It's not a giant gaping hole, but it's caused some concern in the market, particularly when they've cut refining runs so that they're no longer buying as much crude, turning it into product and exporting it into the market, which is their typical play. So I think when we look at the travel data and the high frequency data that I'm looking at over the past couple of weeks, I think it's going to stabilize and get better. However, I think that's a huge concern from the market and will continue to be a focus. I think it's going to get better though.
Which I understand.
And Rebecca, so if you think it's going to get better, you said there's not a lot of marginal buyers out there, but would you be a buyer of oil at these levels? Do you think we're going to see a rebound?
I do think you will. I think, again, when you see kind of all the narrative and all the sentiment extremely negative and nobody can find that silver lining and the positioning gets very light and you start to price in kind of that worst case scenario, where's China demand? Is there any bottom? That's the time when you can start looking to kind of gradually leg into a long and play for an upside surprise, because if nothing else, crude likes to surprise people to the upside and the downside.
Rebecca, also add this up. What does this all mean for gas prices, Rebecca? What do you see there in terms of just near to intermediate term?
So gas prices, that's a good question, because right now refining margins have been exceptionally weak in Asia and the United States, and it's helped really keep gas prices contained. We're at like $3.57, I think, at an average here in the United States. I actually think over the course of the summer, we're going to see a lift in gas prices, probably closer to that kind of $3.65, $3.70 level, nowhere near the point where it starts to make people change their mind on consumption. But I would expect we see a bottoming here. And throughout the course of the summer, we see a little incremental rise as demand picks up and the refiners are able to kind of pick up a little bit more margin. These are very compressed levels, and I just don't think it's sustainable throughout the peak of summer driving season.
I mean, the other interesting thing about all of this, Rebecca, is that we were at one point during the year, we were talking about concerns over oil prices being a feed into inflation, even though, yes, we know the Fed doesn't watch oil specifically, but what if it, sort of became less transitory, so to speak, if companies sort of factor that into their cost. That doesn't seem to be a risk at this point.
I don't think it's a risk the way it was, but I think ultimately when we talk about how it feeds through into the rest of the economy, it's also not, when we're seeing this pullback, I don't think it's being considered like this tailwind for the economy yet. We're not at a point where prices have pulled back where, wow, energy prices are so low, it's really going to help the rest of the economy. So we're kind of in this no man's land. I think there's more fear of what will happen if it starts to go higher in terms of what it'll do to growth than there is the benefit of it continuing to go lower. So I think the focus is always how much damage will it do to the economy if it rises, as opposed to, wow, there's going to be a big tailwind if those costs start to come down. And I think part of that is just embedded in this inflation that has been rampant across the broader economy, not just in energy. So I think that fear of inflation is still there, and I don't think that's going to go away until inflation broadly is more contained. There's still going to be a focus on energy inflation, and there's going to be fear around it.
And as we know, we're not holding our breaths right now for that broader relief. Rebecca, thanks a lot. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, it's a big year for politics beyond the U.S. with consequential elections over the weekend in both Mexico and India. We'll discuss what the new leadership could mean for emerging markets. Plus, going green, Apple stock back in positive territory for the year. We'll take a close look at what's driving that turnaround. All that and more coming up on Market Domination.
The number of job openings in the U.S. hitting a new 3-year low in April, the latest sign of a cooling labor market ahead of that big Friday's jobs report. A weakening labor market could help bolster the case for the Fed to lower rates in 2024. Our next guest expects 2 cuts by the end of the year. With us now to discuss all this is Michael Kantrowitz, Piper Sandler Chief Investment Strategist. Michael, good to see you on set.
Thanks.
So let's start there, that economic data, because we got more this morning, and demand for labor seems like it continues to moderate, and it kind of, this kind of general drumbeat now of maybe some softer data we're getting. What do you make of it? What does it mean for the market?
Yeah, I think it's more of the same. The chart you guys just showed, it was just a downtrend that's been going on for a while. There was a bit of an acceleration in this month, but when you look at the broader jobs data, from everything from non-farm payrolls to the unemployment rate to temp employment, hiring plans, quit rates, et cetera, there's been this underlying slowdown going on for about a year. It's broadening, so there's more data points slowing than they're strengthening. I still think it's good news for equities that it helps to quell inflation fears. And I think we've got a ways to go before we have to worry about a real hard landing taking down equities broadly.
One of the charts in your latest note I thought was really interesting, where you talk about a potential generational shift in investor psychology. And, for the past, decade, we had yields and stocks going in the same direction, which had reversed the couple of decades before it. Are we now seeing another reversal where we're going to see renewed inverse correlation between yields and stocks? And what does that mean? What are the implications of that?
Yeah, it's, my entire career, I started roughly in 02, 03. Basically up until COVID, we did have a positive correlation between interest rates and stock prices. And that basically, to me, tells us that no one's really worried about inflation. And when rates go up, the economy's getting better, the markets are going up. From, again, the last 20 years, not a lot of concern. That changed with COVID. It changed due to zero rates and these big refinancing gaps we have in commercial real estate, residential real estate, corporate credit. So I think because of that, it's going to persist, this negative correlation between rates and stocks for a while longer. In the 70s and 80s, it happened because we had really high levels of interest rates and inflation. We don't have really high levels. We just have these big high gaps between where rates were because of zero interest rates. So I think there's a lot of reasons, but until we see investors not worried about higher inflation, higher interest rates, a rate hike, when the data improve, I think we're going to continue to see this negative correlation, not literally every day. I know today yields are down a bunch in the last couple of days, actually, and stocks really haven't positively reacted. But if you run that correlation over a real short period in time, you'd see it flip-flopping a lot, whereas I look at over about 6 months to really capture a regime, and it's been pretty negative for about the last 2 years.
We mentioned, Mike, you're expecting 2 cuts from the Fed this year. What if that didn't materialize and you had no cuts? Would that change your view of the market? Does it need cuts to keep moving higher?
I think I think smaller caps, areas, mid caps that don't really have robust or broad-based earning strength. Yeah, I think regional banks, transportation stocks, real estate stocks. There's a long list. Again, this all goes back to all these names that are rate sensitive. Does the large cap growth index, the 500, need lower rates? Not necessarily, because there's still earnings growth there. Will the growth will stock prices go up as much without rate cuts, or if the 10-year yield stays here? No, I don't think so. So I think if rates stay where they are for longer, it's more of what we've seen with this large cap quality growth leadership, small cap value underperformance.
And at the same time, even though we've gotten a couple of, or maybe more than a couple of negative economic data points at this time, you, again, in your most recent note, you talk about maybe some stabilizing factors that are underpinning the economy that give you a little optimism that, maybe things aren't going to be fantastic, but maybe they're not going to be a lot worse.
Yeah, I'm taking a little bit from the bearish economic side and a little bit from the bullish economic side and kind of landing in the middle. The bullish economic story is that oil prices are low, we have a lot of fiscal spending, we've got a flexible labor market, a strong wealth effect from the boomer generation, and all of that's going to prevent a recession. Well, maybe, but with all of that said, we do see the JOLTS data coming in weaker. We do see softer underlying earnings when we look more broadly. So we are seeing a slowdown with all of that. But perhaps it means it's a more moderate slowdown. Perhaps this is why some like me and others last year were wrong in calling for a recession earlier because of these mitigating factors. And so I think the Goldilocks environment today is that it just continues to offset some of the impact of higher interest rates, and that we just continue to grind slower, not fall off a cliff like previous recessions we have seen.
And Michael, let's sort of add it up for viewers who are listening right now, given that kind of viewpoint you have. Where do you see opportunity in the stock market? What are you screening for?
Still, quality companies with higher profitability. I think one of the sectors that's interesting is utilities. I've kind of said it could play Iron Man offense and defense. It's a football reference, American football. And so utilities have certainly played offense for the last 2 months, playing with the kind of on the back of the AI story and the drop in yields from 4.7 about a month ago. And if things do become bad, and bad news becomes bad for equities, and I would presume rates would go down, and utilities there can be your kind of safety play as they have the most stable earnings backdrop. So aside from that sector, generally just looking for stocks within different sectors and industries that have the best earnings momentum relative to their peers.
And just real quickly, utilities is unusual because it's already had a run, even though rates haven't really come down because of this whole now AI thesis about them as well. But you think they have more room to go if rates do come down?
Yeah, I think if we do end up having a hard landing recession, things get worse, utilities will be the last part of the market hanging in there. Perhaps, again, maybe not the AI stocks that have led the move, but you'll see a rotation within utilities to more stable bond-like equities within there.
And that's perfect because we've got our playbook today on utilities. So we're going to get some specific names
timed.
as well from folks to how to play that. Thanks so much. Good to see you.
You too. Thanks
for being here. And it's time now for some trending tickers. We're watching Warner Brothers Discovery. It's the latest streamer to announce a price hike. Alexander Canal is here with more details. Yesterday we were talking about music streaming price hikes. Today we're talking about video streaming price hikes.
I know, and unfortunately, if you're a consumer and you sign up for these streaming services, it's going to be more and more expensive to watch your favorite shows. Now, Max hiking its ad-free offerings by $1, so that means that monthly ad-free plan that's going to now cost $16.99 instead of the prior $15.99. And then the ultimate ad-free tier, this is a tier that allows 4 concurrent streams and 4K streaming options. That's also going to increase by $1 to $20.99 a month. Although I will mention that the ad-supported plan, that's going to remain in place at the price of $9.99 a month. So the price hikes come just over a year after we saw Discovery Plus integrate with HBO Max. It also, I think, strategically comes just ahead of that House of the Dragon Season 2 premiere, which is scheduled for release on June 16th. And over the past year or so, we've really seen streaming companies be more aggressive when it comes to hiking prices. Those ad-free tiers, that's really been the target there as these media giants look to pull viewers away from those specific tiers and maybe gravitate towards those ad-supported plans. They want to up the viewership there. That's been a big initiative when it comes to fueling that top-line growth, especially if they can get more eyeballs on those platforms, maybe potentially get more money from advertisers. So that's something that we've seen across the board. Last year, we saw virtually all of the major media companies hike prices, and that push for streaming profitability, it's a trend now that's continuing in 2024. And it's not just Warner Brothers. We also saw Comcast recently unveil that in July, Peacock prices are going to go up, again, just ahead of the Olympics. So they're really timing it here to some of that key content.
Everybody's got religion now, right? Get profitable. Ad support tiers, raise fees, right?
And you could argue that all of these streaming services were priced probably too low in that attempt to try and just grab as many users as possible. We were briefly talking about that with the Spotify price hikes. You could argue that it's still a pretty good deal, that you have all of this content, you can watch it from the comfort of your own home, and this is what companies are starting to realize. And that's why we're seeing more sticky pieces of content, like sports, for example, be more of an attractive option for these companies to get, because if you have the sticky content, if you have the shows and movies that people love and want to watch, they're probably going to be more willing to pay for your service as opposed to some of those competitors.
All right, House of Dragon.
Are you a big? I know I'm not a huge Game of Thrones girl.
I love Game of Thrones. The books, the series was fine. And
Fine.
I
You give it a
haven't
fine.
watched
You
House
give
of
it a fine.
Dragon.
It's like
No. If we're talking about offshoots of beloved things, give me Rings of Power any day of the week on Amazon. We're talking deep geek here, man.
No, I get it. I get it.
You know?
I get it. Thank you, Allie.
Of course,
Appreciate
thank
it.
you.
It has been a fairly quiet day when it comes to the meme trade, but let's take a look at shares of GameStop here. So a reversal there. We had a nice pop yesterday. We were talking about that after Roaring Kitty posts, reveals his bet. I still think one of the most interesting parts, we were talking about this off camera, was the Wall Street Journal article that maybe E-Trade thinking about barring him, which I think is still a fascinating part of the story that I'm waiting to play out.
Yeah, and the whole idea that the Securities and Exchange Commission is reportedly looking at his options activity.
Although at what though exactly? I'm still waiting to.
I don't know.
Me either.
I don't know. I think that's
We
what
could lose a
everybody
lawyer,
is trying to
an
figure
SEC
out.
lawyer, yeah.
I mean, I think that, as we talked about yesterday with Miles Udland, this is just kind of a feature of the market right now that and not just right now. I mean, this is, even though this GameStop episode is particularly acute, we have seen flare-ups, so to speak, of the meme stock trade really now and then, right? And so it just feels like that's kind of just part of it.
Just a flare-up,
now.
like a bad cold.
Well, it's not necessarily bad. I mean, I guess if you're long GameStop, you've been all right, right? But, it's just that this is a thing that sometimes happens. All of a sudden, somebody starts talking about something on Reddit, whether it's Keith Gill, who is much more followed, or there's just sort of collective chatter.
Although wasn't it so? I thought great conversation we had with Chris Murphy from Susquehanna. How the shift though too, how it's different. How in 2021,
Yes, definitely.
everybody
Yes.
who's the next target, right?
Well, and Andrew Luck said the same thing, which
Yeah.
is why he was willing to come back in and short GameStop after he sort of was scared off before.
Andrew, good interview.
Yeah,
That was a
interesting.
good one.
Yeah. All right, and let's also take a look at shares of Carnival Corporation. It's jumping on news the company is wrapping an Australian line of cruises into its flagship brand. And in reaction to that news, Melius Research says this could be a catalyst for the rally. The stock up 5.5% today. There was also another upgrade to the stock from a firm called Peel Hunt, which said that the company's accelerating a debt for equity swap, and that will make it more attractive as well.
Yeah, I think they were saying that they think it goes investment grade by 26. You saw some names did pop. I mean, Norwegian, Royal Caribbean, Viking. Also, just to bring it back, the conversation we had at the top of the show, Rebecca Babin. I mean, you look at oil and that downward trend. I'm sure that's also given some investors some confidence in these names too.
Yeah, probably not bad news for the margins of these companies as they've continued to see pretty strong demand.
Yep.
So.
Moving on, coming up, the tide has turned. Apple turns positive for the year. Believe it or not, wiping out its losses year to date. We're going to take a closer look with an analyst that's coming up next.
Apple shares turning positive for the year, and they're hovering near their highest level of the year. And it comes just days ahead of the company's Worldwide Developers Conference, which is expected to launch the tech giant's AI strategy. Joining us now is Wamsi Mohan, BofA Securities Senior IT Hardware Analyst, and he's coming to us live from the Bank of America Securities Global Technology Conference. So I'm sure that AI is probably a little bit of a topic of conversation there, Wamsi. Thank you so much for joining us. So what do you expect from that Worldwide Developers Conference? I know there's been a lot of talk about an AI-powered Siri. Is that kind of the centerpiece that you're expecting?
Yeah, thanks for having me, Julie. I'm delighted to join here from our BFA Global Tech Conference in San Francisco. Look, I think that the setup here at the Worldwide Developers Conference is kind of interesting. This has typically been not a huge event, right, from an investor perspective, but this time around, I think things are a little bit different because you do have these two demos that have happened from large tech companies, including OpenAI and Google. And when you look at sort of what the capabilities of the phone can be, that's where the imagination sort of like starts to run now. We're written that the next real upgrade is going to be called an IntelliPhone, in our opinion, right? Like you're going from a smartphone, the step function change you got from a feature phone to a smartphone, you're now replicating that kind of productivity improvement in an IntelliPhone, which what we mean by that is really that you're going to have all these AI agents at the back end going and doing a lot of tasks for the user, so making productivity significantly better. So we hope to hear a lot of these announcements that provide developers the hooks to enable these apps that can then get plugged in. From a conversational standpoint, it's not going to be immediate, but at the same time, we think that enhanced Siri Kit, for example, will be something that would fit where using Siri, you can better integrate into the apps themselves and then be able to have a conversational dialogue and manipulate the app, ask the agent or the AI app to come back with information, preserve that context over time, and then go back to it, right? So we'll change in the way that we use these phones. And so that's why this developer conference is a lot more significant. I mean, there's going to be the standard set of all the tools that we kind of are more commonly and broadly available, including photo and video, image editing, and all these fancy tools that can get enabled with, automatic playlists and stuff like that using AI. But we think the real productivity announcements have to come about the hooks of what you can do from a conversational AI standpoint that they will enable developers to have those hooks in.
Wamsi, I'm curious, as Apple pushes harder into Gen AI and the reports and the rumors are flying fast, who they might partner with. Maybe it's OpenAI, maybe it's Google. I'm curious, Wamsi, which way you think the money would flow. Do you think Tim Cook would be paying Sam Altman or Sam Altman's paying Tim Cook?
Yeah, Josh, no, it's a great question. And obviously there isn't a great deal of clarity around this, but the way we think about this is really that Apple is truly in the distribution business, right? Like, so they didn't have a search engine. When people search, that traffic is directed from Apple to Google, and Google pays Apple $20 billion a year for that traffic being diverted to Google by default, right? So it's more about a distribution business where essentially you're connecting this very lucrative install base of users to that technology, right? So again, we see AI as sort of similar in nature, where you have amazing LLM-based productivity tools sitting with OpenAI or Google, but at the same time, it's hard to get that in front of consumers directly in a quick, efficient way. And then all that data that is collected around those kind of queries will enrich that whoever the provider is by a very large amount of magnitude. It's the same as what happened with Google and Microsoft in some ways. Getting more and more data, search data results just improve the quality of the search engine from a Google perspective. So it was kind of invaluable in some ways to Google. And I think in AI, it's going to be the same thing. The monetization models are not completely clear in terms of money flow, right? Like we're talking large dollars over here, and the balance sheets of some of these companies might not be quite as large. So there might be a different kind of monetization structure to it in terms of maybe revenue share at like an app developer level. Maybe it's the revenue share from usage of infrastructure. So we'll see which way that evolves. But what we're confident about is that Apple stands at the crux of being able to monetize through its real expertise in distribution, which is connecting its 1.2, 1.3 billion iPhone users back to the technology that is so appealing.
Wamsi, are you at all concerned still that all this stuff is not quite ready for prime time? I mean, anecdotally, when you do a Google search now and it automatically uses the AI, I don't know if I trust that stuff, right? So, and we've heard multiple reports of it being kind of giving wrong answers or answers that make no sense. Apple is never in a rush with this stuff. And I wonder if there's a risk for once that it's rushing too much.
Yeah, no, it's a good question, Julie. And as you point out, Apple is very, very measured in its ability to sort of expose tech to consumers and make sure that the tech is kind of ready in some ways. And so what we expect is that there will be maybe an additional orchestration layer of sorts that Apple might introduce to keep things true. So let's say that there is a query and you come back with some results. Maybe there is a filter that Apple will use on top of this to ensure that whatever is the response is compatible with what Apple sort of agrees that this is a qualified response. And I mean, when we're going into the domain of generative AI, it becomes kind of a difficult engineering challenge. So I would say that, there's probably going to be a lot of stuff that would be done on device, which are going to be much smaller parameter models, maybe 10 billion parameter models that are going to be run on device for a lot of basic queries. I think if you've got something else, I think Apple is going to have to figure out a way in which the responses that are coming back from the cloud are consistent in some ways with their approach. And by and large, I think that a lot of the problems that we've seen so far around hallucinations or maybe being trained on poor data. So there are quality control issues that I think Apple will have to contend with. So it's a very legitimate question. I think it is still pretty early stages. So in that way, Apple will have to be measured in the way that it comes out and deploys. That's why I think it's very important to give specific interface hooks into Siri, and then you have an API creation that kind of keeps it under Apple's control, right? And then Apple qualifies these apps. So that's one way in which they could do this in a more protected manner, so to speak.
All right, all eyes on Apple's big software show. Wamsi, it's always great to have you on the show. Thanks for making time for us.
Of course. Thank you, Josh. Pleasure to be there.
National elections in both India and Mexico could shake up those countries' economies and investments. Here to help us understand the fallout is Malcolm Dorson, Senior Portfolio Manager and Head of Emerging Markets Strategy at Global X. Malcolm, thanks for joining the show. Let's start with India, Malcolm. And you see these headlines. It looks like election results showing a tight win for Modi here. What do you make of that, Malcolm? And what does it mean for investors?
Well, thanks for having me, Josh, Julie. Nice to see you guys. So the past couple of days have been really volatile. Broadly across emerging markets, we've seen elections in Mexico, India, and South Africa. But India specifically, going into the last night of elections, exit polls showed a remarkably strong victory for Modi and the BJP. And now as we're seeing real numbers come out this morning, it looks like the margin of victory was much smaller, meaning that we're going to move forward with the coalition government.
And so what does that then mean? I mean, it seems from what I'm reading that some of the implications are that maybe there was some dissatisfaction with the vast inequality, economic inequality that's going on in India. But what are the implications for Modi's ability to affect his economic goals? Yeah, so from an investment perspective, the market was very enthusiastic and excited about a potential majority victory last night. Market was up 4% yesterday. And as we saw the real numbers come in today, we saw the Nifty 50 fall about 6%. Big picture, I think the market's getting a little bit ahead of itself. Modi is still in power. A coalition government isn't necessarily a bad thing. It provides a good system of checks and balances. And big picture, India isn't a 2-week story. This isn't a 1-week election story. This is a 20-year story that's probably the best structural setup that we see in the world. It's benefiting from not only democratic elections, but a market-friendly government, very attractive demographics, momentum out of China in terms of manufacturing and supply chain diversification, and a very unique digital stack that's well ahead of its curve. So I manage an India fund, and the pushback that I always get is, does India seem a little too expensive or multiples a little high? And in general, yes, especially the past year or two, we've been at a bit of a premium towards its historical average.
But now this is it. We just got a 6% pullback on the whole market with no downgrade to earnings, and the country's still growing 7% GDP this year. So frankly, I'm really excited.
Malcolm, let's switch gears, talk about Mexico as well. First female president there. Are you equally bullish on Mexico, Malcolm, for an investor with a long-term time horizon?
Sure. So this one's a little difficult, more difficult, say nuanced, for lack of better words. I think this is more showing the risks behind a candidate winning too much power. Though we expected a Sheinbaum victory, she did much better than expected in terms of support in the Senate and the lower house, which is going to give her much more power and much more control. Between her and her predecessor, AMLO, they'll be able to name 9 out of 11 Supreme Court justices before the end of her term. And I think there is risk of more state intervention, of more spending. We've seen a big pickup in the fiscal deficit through the past few months that are going to be very difficult to turn back once she is in power, because she's either going to have to raise taxes or cut subsidies to the lower portions of the economic pyramid, which is totally against her ideals. So I think that there is risk with a higher fiscal deficit that could translate into higher inflation and a weaker currency, which of course, as a US dollar investor, would create a challenge. So we've been able to trim our positions in Mexico a little bit ahead of this.
And just briefly, Malcolm, then, do you think whether we're talking about India or Mexico, that you expect in the near term at least some continued caution and kind of at least a sideways trade perhaps in equities there?
Certainly in Mexico. I think that especially in terms of smaller cap, higher beta trades, people are going to be moving out of those and probably more into kind of quality, safer blue chip names. And then in India, I think that we're going to see people refocus on fundamentals, on equity stories, and not just buying momentum, not just buying small caps, buying beta anymore. They're going to see this more as a system of checks and balances, and it's going to be a good opportunity for stock pickers across the board.
Thanks a lot, Malcolm. Appreciate it.
Thanks for having me.
Well, President Biden taking action on securing the southern border, the executive actions to bar migrants who cross the border unlawfully from receiving asylum. Here with more on what this means for Biden and migrant flows, let's go to Yahoo Finance's senior columnist, Rick Newman. Rick, there has been a lot of talk about this issue. We haven't seen really much congressional action on it, right? Despite President Biden supported bill that was before Congress earlier this year. So I guess he's taken the bull by the horns here.
The last major congressional action on immigration was in 1996.
Wow.
So it's been a little while. There was, of course, this little flurry of activity in the Senate earlier this year where there was some bipartisan agreement on an immigration deal, but Republicans who supported it, then they changed their mind. They bailed out. Democrats said that was because Donald Trump said, don't give Joe Biden a victory on immigration. Just let him deal with the problems at the border, because they thought that would be a better advantage for Republicans as a political liability for Biden. So Biden has now issued this executive order. Basically, what this executive order is going to do is sharply raise the standard for applying for asylum at the border when border crossings, sometimes called border encounters, when they reach a certain level, which is going to be a 7-day average of 2,500 border encounters. And we were already above that level. So this basically goes into effect today, immediately. So there will be a sharp reduction in the people who can qualify for asylum when they come to the border, the southwest border. So that what happens next is that's going to cut down on border encounters. And then when the number gets below 1,500, so it goes into effect when the number hits 2,500 or more on a 7-day average. And then they suspend these stricter standards when it falls below an average of 1,500 per day. And the idea here is, as the news of this and the stories about people getting turned away, as this ripples through the system, people who think they want to come to the southwest border and take their chances getting into the United States, they're just going to say, maybe it's not worth it. Maybe it's not paying the thousands of dollars to smugglers, because when we get there, there's a much greater chance we'll just get turned away. And by the way, I would add, we were talking about Mexico. What's been happening this year is behind the scenes, Mexico has actually been interdicting a lot of migrants before they even get to the U.S. border. So border crossings last year, especially in December, they hit record highs, but they're down by a lot from those levels. So nonetheless, Biden thinks he's got a big political problem with migration. It's one of the worst issues in terms of polling. So he's doing something about it.
Rick, quick follow here. Speaking of the southern border, Mexico just electing its first female president. How could that, in your opinion, kind of factor into U.S.-Mexico relations from here?
Probably steady state. Claudia Sheinbaum, who is the incoming president, she's an ally. She's the same political party as López Obrador, AMLO, as he's known. And relations have been pretty good between Mexico and the United States under AMLO and President Biden. There are some issues. They relate to trade in many cases. There's obviously drug trafficking, fentanyl that's coming into the United States across the Mexican border and killing a lot of Americans. So there is some tension there, but generally the two administrations have been getting along, and I think most analysts think that will continue to be the case. And that's very important for Biden to make voters think that he is making some progress, cutting back on migration on the southwest border in the 5 months leading up to the election, because this has become a big deal for voters who are seeing this on cable news and think this problem's out of control. So Biden needs to be able to demonstrate to them he's doing something about it.
We'll see if it works. Rick Newman, thanks a lot. Appreciate it.
Bye, guys.
Coming up, AI's energy usage could mean big gains for utility names. More on how to put power to work in your portfolio on Market Domination.
The utility sector outperforming so far this year, closing out its best May since 2003. But for investors looking into the defensive sector, traders may find a fresh perspective of opportunity with utilities. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. Brett Kenwell, eToro, U.S. investment and options analyst, along with Sophie Karp, KeyBank Capital Markets equity research analyst, joining us now to discuss. Welcome to you both. And Sophie, I'll start with you. We're actually, Sophie, at the start of the show, we were talking to Michael Kantrowitz from Piper, who likes utilities, and we were asking him why, and he referred to them as sort of the Iron Man of the stock market, Sophie, in the sense that you're kind of playing offense and defense when you're in the utilities. You agree with that, Sophie?
Well, thank you for having me. And well, I obviously like utilities. We are bullish on the space, and we have been bullish since the start of the year, and even from before the start of the year. And I think with the AI rush sort of emerging here, I would refer to it as, we have this gold rush, and utilities, power companies are the ones who are selling shovels into this gold rush. And so I think it's an excellent way to get exposure to this trend, of course. And it's a way that also offers defensive characteristics because of the nature of this non-cyclical nature of this sector. And it's historically still inexpensive relative to where utilities historically traded versus bond yields and versus the S&P 500 as well.
Well, and kind of to Sophie's point, Brett, what's interesting here is, as the market more broadly has come to this higher for longer realization, normally that would not necessarily be a great recipe for utility stocks, right? But because there is this alternative narrative now about AI, they have been supported in a time when maybe they wouldn't otherwise have been, right?
Yeah, I believe that there seems to be a sort of multi-catalyst approach to utilities at the moment. They are typically a more defensive sector, but right now we have the AI catalyst helping to fuel the recent gains. And while the idea of interest rates, or at least lower interest rates, have been pushed back, I think investors still have that on the front of their minds. And when you look out over the next, say, 6 to 12 months, the expectation is pretty clearly that the Fed will be cutting interest rates. And between that and AI, it's a kind of a unique catalyst, I think, for utilities. And it's part of the reason why it's performed so well this year.
Sophie, bring back to you. We've had a number of strategists, Sophie, come on the show and pound the table for utilities. It's not a new theme, and investors have bid them up. Broadly, when you look at the sector, Sophie, do you consider it still, attractively valued here?
Yeah, we do. I think when we look at the valuation of benchmarks where the sector trades versus the S&P 500 versus bond yields, like I mentioned, I think it's still historically inexpensive. It's outperforming now, but look at the slightly longer chart, and we coming off like a year or two of underperformance versus all the major indices when the cyclicals were outperforming and utilities were essentially flat or down. So in my mind, we're just in the beginning of this reset for the space, and the trend is real. Like it's visible in the power prices where there's merchant market for power. Power prices are at levels we have not seen in a very long time. For the first time in like a couple of decades, probably, we're seeing actual growth in power demand in the U.S. I think it's a really big change. It kind of shocked people into realizing that the space has a lot of potential.
I guess my big question when it comes to that increased demand, and Brett, I'll take this one to you, is whether the power companies can meet that demand, especially if it continues to go up because of these data centers, for example. Can the grid take it? Are these companies going to need to make big new capital investments in order to keep up?
They may need to, but back to Sophie's point, I think that the group is still, even though it's had a big run, it's still attractively valued. And even though we've had sort of this giant rally, whether you look back over the last few weeks or you look back, year to date, or even all the way back to November, even though some of those catalysts might require more investment from those groups, the earnings expectations are still pretty strong, and the valuation hasn't gotten out of control especially compared to where it has been over the last few years. And so I think when you look at sort of the bigger picture for utilities, it still remains attractive, even with all of those considerations at hand.
And Sophie, it's a good question, so I want to get your take too, whether power companies can meet this demand, just given AI, crypto, EVs. What do you think, Sophie?
Yeah, and I think it's for sure they can, right? It's just a matter of how well aligned the timing of that is going to be with the how fast the AI and the tech industry wants it. And I'm not sure what the tech guys are projecting here, but it's possible to build generation relatively quickly in certain places in the U.S. And I think it takes probably a couple of years to build a gas plant. It takes a couple of years to build a solar or wind plant. And we see a lot of, and because the US is not a centralized grid, we kind of see that naturally tech customers are gravitating towards the places where there is capacity right now. And so we're not actually seeing, right now a situation where power demand is not being met. So there are definitely places in the country where there is capacity available, and there are some places that are more tight, right? So for example, Northern Virginia, that's been a data center, heaven for a very long time. They may have to wait longer if they want to interconnect there. But anywhere in the country, like in other regions, that can be accomplished faster. And what we're seeing is its customers spread out.
And Sophie, just quickly before you leave, are there particular utilities that you think are best positioned, either because of where they're located or their cost of power, for example?
Yeah, I think definitely. It does, and the customers tend to triangulate, like they want cheap land, they want affordable power, they want time to market. And from that standpoint, we would flag as the southeast of the US, and they also want access to fiber, right? So when you overlay all of these factors, you have advantage in sort of the southeast, and we would flag Georgia, potentially other southeastern locations, right? So that would be Southern Company that benefits from that. And we would flag like middle of the country where one of the largest publicly traded companies is Xcel Energy, XCL. So that's another area where we see potentially influx of data centers. And of course, the usual suspects, Dominion Energy, who services Northern Virginia territory.
Sophie, Brett, great discussion. Appreciate your time. Thank you.
Thanks for having us.
Well, wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start where major averages ended up here. We see the Dow still in the green here, although off the highs of the session, still up a little more than a third of 1%, 140 points. But the S&P and the Nasdaq also strengthening into the close here a little bit. Listen, this is not a runaway rally, but still in the green after we got worse than estimated economic data this morning in the form of the so-called JOLT survey, that is jobs, opening, and labor turnover survey, which showed at the end of April the lowest number of job openings going back to 2021. So the S&P up here, the Nasdaq up as well, helped in part by what we saw in the bond market, which is this continued come down in yields, another 7 basis point state of 4.34%. And if you look here, we're at the lowest that we've been, call it since early April in the bond market. So all of that percolating through stocks today, Jared.
Yes, and let's take a quick look at the VIX, which has come down from, I'm not even going to call it a recent peak, it's just an interim high here. That spike up maybe led some traders to believe that could be the beginning of a move, and it still could be. But right now, as you said, Julie, bonds really helping out stocks here, just kind of taking a back seat. Now, here's the sector action. We got real estate up about 1%. That's in the pole position. After that, you got staples, communication services, healthcare, and then also tech. All of those outperforming. Materials, the worst to the downside, that's XLB, followed by energy, financials, industrials, then utilities. So really the value and cyclical trade getting hit the most today. If we take a look at our leaders, Bitcoin, that's in the top spot, that's up about 1.75%. And oil, small oil that is, PSCE is smaller oil players, that was down almost 3%. Also home builders, that's XHB and XRT, that's real estate feeling a little bit of weakness there. And I did mention the banks were seeing some red today, and that is indeed the case here. Not a lot of, well, that's actually energy. Let me show you the banks here, if I can get that. There we go. JP Morgan down about 1.33%, but not seeing a lot of outliers. And in fact, that's kind of what we're seeing in the energy sector as well. Haven't checked out travel in a while, so this is actually a bright spot today. We can see Hilton up 1%. The cruise lines have been volatile lately, but up today. Royal Caribbean up 2.5%. Carnival Cruise Lines up over 5%. Guys.
All right. Thank you, Jared. As Julie just mentioned, job openings fell in April to the lowest level since February 2021, showing further signs of the labor market cooling off. Joining us now is Emily Rowland, co-chief investment strategist from John Hancock Investment Management. Emily, always good to have you on the show. So stock market relatively muted today, Emily. Bond market climbed. What do we make of this U.S. stock market, Emily? Where we are and where you think we're headed?
Yeah, it's pretty notable. It's starting to feel a little bit like bad news might just be bad news. We've talked already about the miss on job openings, lowest level since 2021. We also saw the ISM manufacturing index disappoint here, new orders in particular slowing down. The Atlanta Fed GDP now measure was as high as 4% for Q2 at one point, and we're down to 1.8%. And I think it's pretty notable that you have seen the reaction across treasury markets, 10-year treasury yield down 7 basis points today, but yet small cap equities are down over 1%. So I think there's a feeling out there that cyclicality is not going to get rewarded in an environment where growth is slowing down pretty notably here.
And is the perception also, Emily, hey, it's Julie here, is the perception also that the Fed is not necessarily going to come riding to the rescue, at least in the sort of short to medium term, that even with these numbers that are rolling over, maybe we're still not going to get a cut for a while?
Well, that's the challenge here. I mean, we've got an environment in which, growth is slowing, but inflation's still remaining pretty stubborn. It all started when the Fed just suggested that rate cuts were coming. Back in the fall, financial conditions loosened. You saw this bounce in the housing market. And so the challenge now that growth did pick up in the first quarter. Of course, that's slowing now, as we talked about. But the kind of nasty side effect of growth reaccelerating is that inflation comes with it. So the Fed still has a bit of an inflation problem to deal with here. We'll look at the non-farm payrolls report on Friday to see how that's showing up in terms of wages. But they could be backed into a corner here if inflation doesn't come down enough for them to justify cutting rates in the back half of this year.
Emily, having said all that, for viewers who are listening right now, I'm going to guess you're going to suggest I still own stocks. Which stocks, Emily? What looks attractive to you here by sector?
Sure. What we've been doing is trimming riskier assets here. We've seen a big surge in momentum. Sentiment's been elevated. We want to avoid things like meme stocks, which have been coming back into the mix here. We want to avoid deep value type sectors. We're looking to increase quality in the portfolio, leaning into companies with great balance sheets, lots of cash, and just finding quality at a reasonable price is really the name of the game. So looking for those strong fundamental stories where businesses can have lower interest burdens, great profitability, and just the ability to navigate this late cycle environment.
Is it hard to find those names right now, Emily?
There has, Julie, been some increased breadth across the market. So we're not just finding it in tech. Tech was kind of the poster child for great earnings results. But we're seeing areas like communications services participate, utility sectors participating. I know there's been some discussion around utilities this afternoon on your programming. So there has been some other opportunities. We're even we're finding some quality on the value side as well. Healthcare, for example, has some of the best return on equity metrics that we're seeing across the S&P 500 sector. So there are places to find it. And I think it can be a more idiosyncratic stock-specific story here where active managers should really be able to capitalize on some of these strong fundamental stories.
Emily, what about utilities? I asked just because, today's show, we were talking to some smart folks who like that sector. One of them kind of described it as the Iron Man sector. You get to play offense and defense. What do you think?
Yeah, we like utilities in this environment. Of course, the yields there are going to be more attractive as bond yields come down. I think that's one big part of the story, but there's also a lot of investment in utilities in terms of modernizing the grid and seeing a lot of the fiscal spending that's going on being funneled into these projects, which are more long-lived. We also see a big change happening right now as the consumer comes under pressure. We are seeing cracks in this consumer as people are sort of protesting higher prices, especially that lower end consumer. But we look at that as an opportunity. People are going to continue to buy the stuff they need, pay their electric bill, pay their utilities, even if they're not necessarily buying the stuff they want. So I think there's a number of different catalysts in place that should support the sector.
Well, and then outside of stocks, Emily, is it finally time to go back to bonds or do you stay out?
I know, Julie, we love bonds. Yes. I would say, we just love the income potential there. We've had a lot of volatility in the bond market as of late. Yields have come down significantly here over the last few weeks. 10-year treasuries was sitting at, 470 not too long ago here. So we would be looking at any backups in bond yields here opportunistically. We do think this deceleration in economic growth is the real deal. It might not come, it'll probably come in pretty choppy fashion in terms of the rates backdrop, but ultimately we think that rates will fall into an economic contraction here. It may take some time, but the good news is that you can get paid to wait here, 5% to 6% income in high quality bonds. We still like it.
And Emily, in terms of U.S. stocks, do you want to stay U.S. centric or are there opportunities overseas, internationally?
Yeah, we have been overweight U.S. versus international indices, and a couple of key reasons for that. We've seen better relative economic growth here in the United States. It's not a huge differential, but we're holding in better here, and that's translated into better earnings growth in the U.S. Analysts are penciling 11% earnings growth for the S&P 500 this year, almost 15% next year. That is the best earnings growth that we're seeing across global indices. We also, because we like technology companies, you sort of automatically have an overweight to U.S. equities, given the fact that we have a much bigger sector composition focused on tech companies here in the United States than there is international. So a few things going. A stronger dollar, I would say, would be sort of the cherry on top. We continue to believe that the dollar will strengthen into this year as the Fed remains the last central bank standing with restrictive rates. So all those things pointing to an emphasis on domestic equities.
Good to see you, Emily. Thank you.
You too. Take care.
Let's get to some breaking earnings news now. Hewlett-Packard Enterprise out with its second quarter results. So let's break down those numbers. And the numbers look strong, as you can tell probably from the share reaction, up 8% here. The company coming out with its fiscal second quarter net revenue that rose 3% to $7.2 billion. Analysts had been expecting a drop year over year to $6.82 billion. You can see adjusted earnings per share also coming in ahead of estimates. And in particular, server revenue here, $3.87 billion, also ahead of estimates. Hybrid cloud net revenue was in line. So it really seems like demand for AI servers is what was powering the numbers higher. The company also coming out with a forecast for the third quarter, both revenue and earnings per share. It looks like earnings per share leaves it room to sort of be in line with estimates, but revenue looks a little bit better than analysts had been anticipating. And looks like the company is also raising its forecast for full year earnings per share.
Yeah, it's interesting. The stock had not done a whole lot heading into this sprint. It was only up about 5% this year. Julie, but at least initially in the after hours, it's roaring. It was curious because as analysts were getting ready for this print, some of them had, even bulls actually had called out some worries about networking and demand there, inventory digestion there. But as you mentioned, the big focus has been AI, revenues, backlog, and their execution on here. I haven't seen the release yet, but also obviously you're looking for any kind of updates on that pending Juniper acquisition, announced that in January for around $14 billion, the close of the H3C divestiture. So lots of questions for the CEO on the call.
Yeah, I'm seeing a couple of details here that sales of AI-oriented systems doubled in the quarter. So even though revenue overall didn't get that much of a lift, in particular, there is that strong demand for AI-oriented systems here. So that company, it's so interesting to me throughout tech, kind of how this whole AI thing is trickling down. You see the likes of an NVIDIA that just has, triple-digit revenue gains every quarter. We're not yet seeing that play out with many other companies in terms of the magnitude of growth. They're getting sort of pieces of that, but we'll see if they get to that kind of point.
For HPE, it was interesting because when it comes to AI, there were certainly folks who thought, listen, they've got what they need to succeed there. Maybe the only questions were, can they stick the landing? Can they execute? At least initially in the after hours, investors seem very pleased.
Yes, we'll see what happens out of the call. And we will also see what happens when we hear from Antonio Neri tomorrow. That's when our Brian Sozzi, our executive editor, will be speaking with the HPE CEO on these latest results. You don't want to miss that. Let's get to another report, though, and that is from CrowdStrike. That stock down a little more than 1%, or adjusted earnings per share in the first quarter beating estimates. Revenue also of $921 million, also beating estimates here. And it looks like the company's second quarter forecast for both earnings and revenue is well above what analysts had been anticipating. It's also raising its forecast for full year earnings per share and full year revenue, but the stock is down.
Yeah, expectations were high, heading into this one, Julie, and the stock was up like more than 20% year to date. And I think for this sector, we've talked a lot about the names in this sector as they reported earnings. It has been kind of choppy, right? A choppy environment. If you're bullish, and there are a lot of bulls on this name, by the way. I mean, it's like NVIDIA-like love for CrowdStrike. I mean, more than 90% of analysts have a buy ring. I think it's because you're betting, listen, the company can kind of execute through that choppiness. On the call, you're gonna have a lot of questions about newer products, and obviously for CEO George Kurtz, lots of questions about pricing, competition. Shares kind of dipping here, at least initially.
Yeah, I mean, as you said, they've done well into this report, but not crazy well. I mean, they're up about 20% year to date. Kurtz, by the way, in this statement here, talked about the company's momentum and strength going into this quarter. He talked about the competitive moat that the company has from its Falcon platform, and that they're seeing demand from customers of all size here. So, unclear where there is any disappointment, if any. The company also is talking about record free cash flow of $322 million. That revenue number, by the way, for the quarter, up 33% year over year.
And so you just moved the stock. You flipped it into the green. You see that?
I did it.
Yeah, Julie Hyman. There you go. You're welcome, bulls. Coming up, AI may not be the productivity booster it's been hyped up to be. We'll discuss that next on Market Domination Overtime.
Unless you've been living under a rock, you've heard all about how AI will change our lives, supercharge economic growth, boost productivity. But a new study by our next guest says not so fast. Joining us now is Doron Ajamolu, economics professor at MIT. Thank you so much for being here. So basically, in your new study, you tried to quantify, as others of course have, what effect this is all going to have on economic growth. The difference is you came up with a much lower number. So talk to us first of all about how you got there.
Yeah, guilty as charged. Look, I mean, I think there's a lot of excitement about AI, and no doubt that these models are performing things, doing things that people thought would be impossible 10 years ago. So there is a big achievement here. It's impressive in many ways. But when you actually look at the data, most of the things that humans do, these models still cannot do. You know, in 50 years' time, all bets are off. We don't know what's going to be possible, what's not going to be possible with AI. But for the next 10 years, we more or less know what the technologies are going to be able to do, because we have already the prototypes. They're evolving at some rate, and more or less we know what that's going to be. So there's a lot of uncertainty, but at least we can put some numbers in there. And on the basis of other people's estimates as well, I come up with a number that about 4.5% of the things that American workers do can be impacted directly by AI. I mean, many more things may be indirectly impacted. That's harder to know, but directly impacted is about 4.5% of the economy. And then when you take that and then put together with what types of improvements in productivity and reduction in costs that these models currently deliver, either because they're automating some tasks or in a few cases they're helping workers, then you end up with something like less than 1% of GDP, exactly like you've just summarized.
Well, it's interesting, Doron, because I know you do work also on economic inequality, how these changes are sort of distributed. And so when you look at that increase, how is it going to be distributed? Who is going to benefit the most?
Well, you know, the good news there is that if we came up with a number that said, you know, 50% of all jobs are going to be impacted by AI, then the distributional effects would be major. You know, there could be millions of people losing their jobs. But if it's only 4.5% or so of the economy, then the distributional effects are not going to be huge either. It's not going to be massive job losses within 10 years. But the other thing that's interesting when you look at the data, you see that the kinds of occupations that are being impacted by AI are much more equally distributed across geography and across demographic groups than, say, things that were impacted by robots. Like, you know, if you look at robots, what did they do? They, you know, took over welding and painting and other things that were involved in heavy manufacturing, and that impacted blue-collar workers. That's a specific group of many, often male, low to middle education groups. Many of them were in places such as the Midwest. And so the effects were very concentrated. AI is much more dispersed, so it's not going to have a major negative effect on inequality. But on the negative side, some people were dreaming that AI may suddenly make us more equal because it's going to help low productivity workers. I don't find much evidence for that either. One bad thing is, you know, AI, just as other automation technologies, is going to probably increase the gap between capital and labor. It's going to help capital owners and managers more than workers.
You know, when you hear people in the industry, you know, I think of Jensen Huang talking about the AI revolution and a lot of other folks using that kind of language. You, of course, have looked at the history of other types of revolutions economically, right? The Industrial Revolution, et cetera. What can we learn from those past historical big changes in the way that we work?
Well, I mean, Jensen Huang is absolutely right. There is a big revolution going on for NVIDIA stocks, and those are doing better than any other stock that I remember for quite a while. So that's what you see from history as well. There are often some big winners from new technologies, especially the kinds of sectors or firms that provide key inputs or the key expertise for new technologies can gain a lot. During the early phases of the Industrial Revolution, some people who were first out of the gate in terms of building big factories made a lot of money. And people who are going to provide the GPU capacity, either in the old form or computational capacity, let's say, either in the form of GPUs or other types of chips that might develop over the next decade or so, they're gonna benefit a lot. But for the rest of us to benefit from new technologies, A, it takes time, and B, I think we need other conditions to be realized. So I don't subscribe to the view that, ultimately, automatically everybody's going to benefit from new technologies. New technologies expand our capabilities, and AI is certainly doing that. But depending on how we develop it, depending how we use it, there may be a lot of inequalities that emerge. The British Industrial Revolution, we owe our comfort, health, productivity, all of this industrial technology to that process. But if you look at the first 8 or 9 decades of that industrial revolution, there was a lot of hardship. Lots of people did not gain. In fact, real wages may have fallen for many groups of workers, including those in the most dynamic sectors of the economy, such as textile. So to avoid that, I think we do need more sort of guardrails, institutional guardrails, be more careful in how we develop the AI technologies. And there are also other more recent examples we want to avoid, like, for example, social media. Great, amazing technological capabilities in social media, improvements in communication that could have been truly transformative, but there's a lot of evidence that we have created huge amount of polarization and mental health problems. So AI could exacerbate those things. So we have to be careful about how we use this very promising technological platform.
Right. And while we have you, Doron, off of AI for just a second here, I'm just curious to get your general thoughts on where we are in the economy right now. I mean, we've been talking all show long about some of the recent economic data that we've gotten that has not been as encouraging.
Well, I think on the whole, the U.S. recovery since the COVID crisis, in fact, to some extent, even perhaps since the financial crisis, has been better than other industrialized nations. And I think a very important part of it is this is a dynamic economy, but also the government stepped in when it was needed, both after the financial crisis and after the COVID crisis. Of course, mistakes were made. We can go back and litigate whether we could have done it in a less inflationary way or whether we could have done a better job in terms of financial regulation and so on. But the reality is that the U.S. economy has proven more robust than pretty much all of the other industrialized nations. And that, I think, over the medium term is likely to continue. But there's going to be ups and downs.
Maybe we're seeing a little bit of a down right now. We'll see how it plays out. Doron Ajamulu, thank you so much for being here. Really appreciate it.
Thank you for having me on the program. Have a good day.
You too.
Time now for To Watch Wednesday, June 5th. Starting off on the economy, we're going to be getting another piece of economic data in the morning with the monthly PMI print for May. Economists forecasting that number to hold steady compared to April.
Moving over to the labor force, the monthly ADP employment report coming out tomorrow. That number expected to decline from April's, and this coming after another weak JOLTS report Tuesday ahead of Friday's monthly jobs report.
And finally, we're going to get some more earnings tomorrow, including Lululemon, Dollar Tree, and Campbell Soup. Dollar Tree reporting first quarter results before the bell. According to analysts, consumables could be the main source of growth in the first quarter for the company. This coming after Dollar General, the rival discount store chain, reporting strong Q1 results last week, but the company's CFO also warning that customers continue to be price sensitive.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's our new show, Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
opportunity for consumers out there as we transition away from fossil fuels to electric vehicles.
Now that's interesting, Kevin, because hybrids are hot, and you kind of characterize there as Goldilocks. Why are they popular, Kevin? And how is Ford kind of capitalizing on that trend?
Yeah, so hybrids tend to be at a price point that's somewhat in between EVs and internal combustion engines. So affordability is always a key fact for consumers when they're looking at vehicles. So the affordability is there, and then you deal with the fact that range anxiety and kind of concerns about the overall usability of EVs and charging and our charging infrastructure and all of that really kind of holds back some of that kind of EV adoption. Where with hybrids, particularly plug-in hybrids, you can get kind of the best of all worlds, where you get the kind of reduction in greenhouse gas emissions and some of the utility that you get with EVs, but then you still have that internal combustion engine around for longer road trips and the like that can really be beneficial for consumers.
And let's talk about EVs too, Kevin. You mentioned it there. What is Ford's sort of tactic and strategy with that market? It doesn't seem like it's a volume game. Is it a cost-cutting game? What's the move for them, Kevin?
So what we've been seeing Ford do is we look at the, which models are seeing the largest kind of price declines, and particularly with the Ford F-150 Lightning and the Mustang Mach-E, we've been seeing some pretty significant price declines on those new EV models. And I think what you're seeing is as that price kind of gets reduced, consumers are showing much more kind of interest on that front. We've seen that a lot with used EVs in particular. The prices for used EVs have dropped quite significantly. And as the prices really start to slow down for EVs, adoption and interest really starts to pick up in line with that.
And Kevin, I just want to get your thoughts on the EV market in general. We're not seeing the growth, Kevin, that we used to. What do you see ahead? What jumpstarts this market?
Yeah, I think we're kind of in a kind of resettlement period right now with EVs, where we had a lot of the early adopters who were very enthused to get into EVs. Now we're starting to get into that more kind of mainstream adoption. I think it's a couple things. Range is less of an issue than I think what people think. It really comes down to charging. The charging infrastructure needs to get much more in place for consumers to adopt a little bit more, and the cost needs to come down. There still is a pretty significant cost premium for EVs, and once we get down to relative cost parity between EVs and internal combustion engines vehicles, I think we'll see a much more faster adoption rate. But until we get that charging infrastructure in place and the cost in line, I think it's going to be a little bit more of a difficult challenge. And that's where hybrids can really come in and help the auto manufacturers out.
Kevin, I want to get you out of here on this. Listen, we talked EVs, we talked hybrids. Give me your take on pickups beyond Ford, just industry-wide, Kevin, as you look at that category. How healthy, how resilient?
Yeah, I mean, it's definitely still really healthy from a sales volume point of view, but we are seeing, as those inventory numbers I mentioned continue to grow, we're seeing much more pickups get into the marketplace. And so it'll be really interesting to see if automakers are able to balance that kind of demand and production without having to increase incentives too much to kind of move those vehicles that are sitting on lots.
Kevin, great chat. Thank you, sir, for joining the show. We appreciate it.
Thank you. My pleasure.
Stocks eke out gains as labor market cools and investors shift their rate cut expectations after weaker than expected economic data. Yahoo Finance's very own Josh Schaefer joining us now with more on the trading day takeaways. Joshua.
Yeah, Josh, we're going to start with that eco data, and you just mentioned the word weak and cool. And yes, job openings did come in lower than expected today, a little over 8 million in April. But I want to take a closer look at a different part of the data and a different way to sort of think about job openings. So what we're looking at here is job openings per unemployed worker. That hit its lowest level since February 2020, Josh. We know what February 2020 is and why that's significant. That's pre-pandemic. So when you take a look at this here, you get your nice line back to February 2020, and that's what economists have been looking for in different labor market levels. Is, are we getting back to pre-pandemic level and sort of staying there? For instance, the quits rate, how many people are quitting their jobs, has been flat for 4 months at 2.2%. That's in line with pre-pandemic levels. And so the takeaway here sort of being cooling, yes, but perhaps just normalizing.
Yeah.
Maybe we're just getting back to where we were before the pandemic, and maybe that's an okay thing, and sort of this soft, weak data isn't actually bad.
So that's what I want to kind of go with you, Josh, is like, was today just kind of one more data point into that general theme we're seeing of softer economic data coming in?
No, it definitely is, and it's interesting to sort of think about the different data points, right? When you think about something like yesterday's PMIs, manufacturing data versus the labor market, because the labor market is still pretty resilient. I mean, you're looking at an unemployment rate that's been below 4% for 27 months. We haven't had that kind of run since the Vietnam War. That's a strong labor market, right? That is, people are still getting jobs. You can also see here, we're still historically, if you go all the way back to 2004, there are job openings. There are jobs for people to apply to. So people feel like, yes, the labor market is cooling, but not enough where it's not going to fund consumer spending, because that's kind of the key thing we're talking about here with the labor market, right? We need to have jobs to go and spend money, and for the companies we talk about every day to make money off of us. And right now, people feel like we're still in that position.
All right, give me Schaefer bullet point number 2.
Bullet point number 2.
Energy.
Energy.
Why are we talking energy?
We are talking energy because energy has not been doing so hot recently. So we spent a lot of the first part of this year talking a lot about energy and a lot about utilities. And utilities and energy started leading when tech came back, right? And they were the top 2 performing sectors up until about a month ago. And what's been interesting here, if you take a look at the last month, you'll see energy has been the worst performing sector. And if you take a look at the last 2 months, you again have energy as the worst performing sector in the S&P 500. Couple things here to highlight, I think. For one, when energy started rallying, we were talking a lot about a potential reflation trade. We were talking about worries in inflation through the first quarter, right? Energy usually benefits in that sort of scenario. Over the last month, as we've been talking about softening data, if the economy slows down, that might be good for inflation. So that's one thing that sort of feeds into it. The other thing that people have brought up, you have oil prices coming down pretty significantly.
Definitely that kind of downward trend you see.
And when you take a look at just overall earnings estimates right now, not that strong for the energy sector, and we know earnings are sort of what drives stock action.
All right, fair enough.
Our last takeaway, we got to flip back to our other screen here. What happened to the meme trade, man?
Reversal.
I mean, we had what,
Huge day yesterday.
We had a day of fun.
You could feel it, yeah.
And like, it's just over. It's already over. So let's take a look at GameStop here. I think it's interesting when you look at GME. I'm looking at a 2-month. You can see it's up 129%. But I want to go to the 5-day, because when you take a look at the GameStop, only up 11% over the last 5 days. You can see that here. And then when we pull up the 5-day actual chart here, so we had the screenshot, you have your jump here, and that's it.
Yeah.
To me, it just has been interesting to sort of watch this, and people are just tracking what Roaring Kitty is putting out on either Reddit or Twitter, and that's kind of it.
Yeah.
Like, there's not a lot of other catalysts
Well,
here.
to your point, that's what, 2021, there was this kind of like, okay, who's going to get it next? Who's got the target on their back? This time, of course, much more focused on GME. Yeah.
We have an entire meme stock board in front of us right now, Josh, a 5-day look.
Yeah.
And if we were really talking about a meme stock rally, we should see a lot more green, and we should see bigger numbers, quite frankly.
You're kind of just bored with it, Schaefer. You're over it.
We're done. We're done.
You're done.
I think this is our last market takeaways with the meme stock trade. That's going to be it.
Josh Schaefer, thank you, my friend. Appreciate it. Coming up, closer look at the dynamics at play in the labor market in our chart of the day. And we're asking for a trend on the other side. per data out this morning. The number of job openings in the U.S. fell to a 3-year low in April. Market now looking to Friday's May jobs report for the latest reading on the health of the labor market. And Julie Hyman joins me now with a close look at the relationship between JOLTS and jobs. Julie.
Indeed, job openings and then the unemployment rate. That is our chart of the day today. So what you have here is job openings as measured by that JOLTS survey. That's the purple line here, and we saw those job openings at just over 8 million at the end of April. And then you have the unemployment rate here, which is expected by economists to have stayed steady last month at 3.9%. So JOLTS obviously a little bit lagging in terms of when the data comes out, but in terms of what it indicates here, it does tend to at least coincide, if not lead a little bit, the upticks that we see in unemployment. That is what we have seen in the past. They have, they kind of are coincident here. And once again here, we have JOLTS heading lower. The unemployment rate, though, it's not necessarily seeing a big uptick at all. I mean, this line looks pretty steady here up until now. So is it going to show a more dramatic increase in the unemployment rate this time? We don't know yet. But what it does show is that it's in line with some of the other economic data we've been getting, whether it was manufacturing yesterday, whether it's some of the recent spending and consumer confidence numbers that have been coming in a little bit weaker and hitting the bond market, as we know, pushing down yields and kind of causing a little bit of trepidation about where we are in terms of economic growth, Josh.
And so, Julie, with the big Fed meeting now on deck, how do you think Jay Powell is thinking through all this data?
I mean, it seems pretty clear that the Fed has been more focused on inflation than they have on what's been going on in the job market. I mean, this is even as, again, if you look at that unemployment rate, which hopefully will come up here in just a second here. So here's the unemployment rate, and you take it all the way back here, going to late 2019. Even if the unemployment rate is ticking up a little bit, it's still at pretty historically low levels. So we don't see a lot of concern being expressed by the Fed yet about that figure. They are really laser focused on the inflation numbers. And still, we do see the trend that by and large, especially if you're judging it by PCE, which is the Fed's preferred inflation measure, that there is some moderation in the pace of inflation. I suspect, who knows what Jay Powell's going to say? I suspect we will get some version of we still need more good data showing us that that trend is intact, but we shall see.
Julie, I think that is a very good, safe bet. I agree. Thank you. Appreciate it. Coming up, Alex Mill chairman and former Gap CEO Mickey Drexler joins us in studio to talk all things retail. That's next on Asking for a Trend. The results are in from major retailers. Signs point to consumers on the hunt for savings as discretionary income is pinched here by prolonged inflation, and we know higher interest rates too. Meanwhile, retail earnings from names such as Abercrombie and Fitch delivering a shining quarter despite a tough consumer spending backdrop. For more on how to read the current state of retail, we have the perfect guest, Mickey Drexler, Alex Mill, Chairman and former CEO of Gap. Mickey, great to see you. I say perfect guest, Mickey, because we were talking off camera. You've got earnings season largely behind you. A lot of retail names, and you got a lot of reports and conference calls, CEOs, CFOs. As an investor, you're trying to get a sense of where this sector is at. And we were talking, I said generally, my gut was, it seems decent, but you're the guru.
Well, I'm not the guru because I make a lot of mistakes between being
gurus. Gurus are allowed to make mistakes.
Well, okay. So I do my surveys before I appear to talk about the industry. And I call them a bunch of people, discounters, designers, and all that. I think it's selectively good. I don't think it's all or nothing. I think quarterly reports, I've learned this after running Gap and J. Crew public companies for years, quarter to quarter. And I asked about color. I wanted to get some color on the discounting today, and inflation is crazy.
And when you do these surveys, this is Mickey Drexler, you're going into the stores?
No, well, I go online.
Is it a mix? Yeah.
Online tells you how much goods are on sale, what percentage is off, and all that. But I've been saying, first of all, inflation to me is kind of a nightmare still. Travel, concerts.
Your point is in that it's increasing at a slower rate, but of course it's still increasing on top of 40-year highs.
You know, the government doesn't have people going to supermarkets, going to fashion stores and shopping.
You actually need food and gas, you're saying.
Right. But how do they know it's slowing in apparel? I hear mostly complaints. Well, I hear complaints about everything. Designer prices. It's stunning to a lot of people, even those who can afford it, because the rate of increased prices is hugely high, and there's doesn't seem to be a letting down. I'm told that the designer business, whatever it means, is kind of slowing down. But if you look at quarter to quarter, pick your spots. And I'm a merchandise product. That's what I look at, long term, and is that a concept that's going to work? That's the unexpected, that sees around corners. And I don't hear a lot of, or see a lot of that. Designers, in my opinion, used to be when I was a young guy, you go to get Gucci buckles, shoes, and it was like a kind of a deal. And today, I don't know where, I'm not from the manor born, but I don't know where people don't buy designer clothes or what level. And the weights for and it's mostly accessories from what I know. And accessories are kind of like carrying around a little logo or maybe a bigger logo. But I think you buy goods, you buy the styles, you buy the products, you buy service. And as I warned I forgot where I was quoted, I said if I were a consumer today buying apparel, I would actually, before I gave them the credit card, I'd go online and see where I can get it at a better price. Almost like a commodity in a way. I know that sounds weird, but there's so many different price issues. And a lot of companies now have an online deal. And if you're a customer, you schlep to the store, you don't know about the online deal unless you know about it, then they'll honor that. So retail, not an easy one. I'm not a good investor really, because, but I'm impressed. Well, not a lot of people. I always mention TJ Maxx because Carol's a great merchant, and you go and that's the real price.
Let me ask you, you mentioned TJ Maxx. I would love to get your take on Gap as well, because they report, Mickey, they knock it out of the park. Stock is a monster over the last 12 months. What are your thoughts on that name?
Well, good for them, all right? But 3 months...
And good for them if you've been in the stock, also good
right.
for you.
Well, I used to be in the stock, but that was a long time ago. I think they're obviously perceived to be doing a good job. I don't pay much attention. I did include Gap in my percentage off summer item sale, but I'm not going to repeat that because Richard's a friend, and I think that moving forward. But 3 months or a year after 20 years of, see, for me, I have a high standard for everything I do and for everything everyone else does. And when I see a stock, not just, oh, great earnings report, boom.
Yep.
Because I think, I don't know, I don't follow Gap, but I think they're happy, I'm sure. I spoke to some friends and I congratulated them.
Can I ask you one trend? I'm very interested to get your take on this. We're talking about this show. How you're seeing online retailers really get into this just old-fashioned brick and mortar game. Like I'm thinking Wayfair, of course, Warby Parker, Figs. It interests me that you see this trend. Do you think that's a smart trend, or there's risk to that?
Well, you know, trend's an interesting word. I've learned not to follow trends because when you follow them, but you got to call the end of the trend. Figs, you know, it's interesting. I met the two founders a long time ago. On their game, every time I go into a doctor's office now or wherever, a nurse, figs, figs, figs.
Yeah.
And people wear that stuff not just to work in a doctor's office. I think they're really smart, and they know much more than I do. I don't know from who would you mention? Wayfair,
Warby Parker. It interests me because I get it, but at the same time, it could be expensive, and it seems like it could also carry risks. Like you're moving into a new area. Like, do you know that strategy as well as you know the online world?
Well,
or maybe there's skills that travel.
The retail business has always been very logical for me. We all have huge practices being a customer. Some of those stores have too many stores. Those businesses are opening too many stores. Gap, oh my God. I'll never forget, I was at an Old Navy in Arizona. I said to the store manager, I said, anything we can do? And she says, yeah, we have 2 stores within 15 minutes each. And you know something? I was so, it annoyed the hell out of me, and I blame myself.
It almost kind of sounds like a Starbucks.
Yeah, well, yeah, and more is not better.
Yeah.
And in stores, I think one at a time, the landlords now, you know, we only have 2 shops, we're opening a 3rd. We get lots of demand for having a shop in someone's area. But the landlords, they're my friends, but, you know, what the rents are. And I actually appealed to a couple saying, you know, Alex Mill is cool. We're getting hot. I always felt that. And I like our clothes at fairly priced. You don't need a mortgage. And it's a taste style that we like. That's what I do. My son started it. Samsak came from J. Crew after 15 years. Gets it.
Gets it. Nikki, I could talk to you a lot longer.
Oh, and I could talk to you.
I love you coming by. Thank you, my friend.
Okay,
it was great to see you.
You too. Have me more often. You know, whatever. Take care.
That is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Nikki's out of here, but we're going to have him back soon. Have a great night.